Welcome back into another episode of the XRP podcast. Today, I'm going to be diving into the Fed, what it's going to look like today. Of course, we'll get to hear from Chair Powell and whether or not we're going to see not necessarily an interest rate change today, but the likelihood of how this is going to play out into the markets. So we are entering what I think is the eye of the storm. If you think about this, if they hold interest rates steady at around 3.5 to 3.75, obviously the story lies into a combination of not only sticky inflation, but also cooling labor markets. That's the thing that we're watching. And of course, you got political pressure from Powell. So we'll get into that with an expert today, which is going to be Rebecca Walser. She'll be joining us here in just a second. By the way, if you guys are not part of our family, you should be. All you have to do is hit like and subscribe right now. Just do that. And of course, that gets you into not only this podcast, but we do a lot of engagement here on the community tab. So it's the one place where you can actually jump in and out on YouTube and get a chance to chat with our team and, of course, share content, etc. I want to thank our sponsor today, and that is Uphold, where you guys can earn crypto better. A lot of things happening with Uphold staking rewards, so you can stake up to 20 different cryptocurrencies and get into the reward side of things. New tokens, early access, along with full transparency. This is one of the best platforms out there to make trades on when it comes to crypto. The other thing you guys should be doing is this right here. Get the card, the XRP rewards card, which comes in the form of an Uphold debit card. And the nice thing about this, guys, is you can do this without a credit check. Also get up to 6% back on all your purchases for the first 3 months. You can get up to 10% back with a direct deposit stacked in on this. So this is one of the best values out there when it comes to a debit card where you can get into your digital assets. Make sure and check out Uphold. Use the link down below. Let them know we sent you. And we'll just jump right into it. Obviously, the topic today is going to be the macro landscape. I think right now what we are faced with around the Fed is and can be a very interesting format. So I wanted to bring in an expert and a show frequent guest. And of course, that is Rebecca Walser. How are you, Rebecca?
I'm great, Paul. Thank you for having me. I'm glad to be here.
Yeah, let's get into a little bit of what's happening with the Fed. Big picture, you think about it, this is most likely going to be a hold. I don't know if it's been announced yet. It might be as we record, but it feels a little different. You know, the context on 3 rate cuts in late 2025, and then the Fed now hitting the brakes. So what is your thesis on how this plays out this year?
Well, I think that from a perspective of Powell, and Powell obviously being, outgoing in May, and really what happened with the Department of Justice launching an investigation into the renovation of the Federal Reserve building, and then Powell making the preemptive or I would say maybe reactionary decision to come out and to publicly address that and talk about Fed independence. I think there's a little bit of an undertone, and I think that it shifted the conversation for sure, Paul, around, okay, well, who is this president going to be appointing and what is their independence going to look like? And I think that the new person that, and Trump has obviously said he's going to let us know who it is soon enough. But I think that the independence question wasn't really in the atmosphere until we had this Department of Justice investigation. And then Powell effectively brought that investigation to the forefront by actually addressing it and having a press conference. Let's be clear. And so now I think that the tone for sure has shifted, because you've really got people that are able to say or isolate this as a potential issue. Is this president trying to unduly influence Powell and Powell's positions, or how he's directing the Fed? The Fed itself is extremely divided. This is probably the most divided Fed we have seen. We are talking about 12 of the 19 members not in, like, totally in opposite camps, and then trying to build consensus as you have someone who's outgoing, as that chair is basically calling out potentially the independence of the governing body as a whole. It does feel like there's a definite tension between obviously the executive branch and the Federal Reserve. And, I don't know if that's not it's unusual, because you always have a president who wants a Fed to be helpful on their economic agenda and can already have a boogeyman and say, oh, it's not me, it's that guy over there that won't cut the rates and let the capital engine just take off. But we do also have to agree, and I certainly am one on the camp of the hawkish nature, the prices of metals, the efficacy of Bitcoin has been brought about in large part over the last years, because we have just so hyperinflated our currency since the 2020 pandemic. So it has made risk off assets or flight to other perceived safety a bigger concern, and we want alternatives. And that is why I believe the blockchain and decentralized finance away from central banks, which, let's remember, the Federal Reserve is not a government institution, it's a privately chartered bank, 1913, and it is it is a private bank. It is a private bank. So what are these central banks really doing? Who really is in charge of them? You can talk about Fed independence all day long, but if we are going to hyperinflate our currency through debt stimulation forever into oblivion, we know how that ends with the Roman Empire. We've seen that happen before. So they should be independent, but they also are accountable to all of us as American citizens. What are you doing with our currency? Obviously, this administration wants them to be more dovish, more accommodative, more stimulative. And I would be on the opposite camp. I would be like, we need the economy to sort of be able to self-sustain without continuous stimulus, because the continuous stimulus, Paul, is a road and a bridge to nowhere. It will never end. It will always be more and more and more. And we can see that with the interest payments jumping up to our second largest expense, that we've never had it that high on the 5 top items of expense before. It's never been number 2 that we've seen in a sustained basis. And obviously now it's just not sustainable.
Well, it was interesting, before we get into the Fed status, one thing, of course, obviously, is their dual mandate, which is kind of a dilemma right now. If you look at the GDP growth, which we're already saying, Bessen's expecting even more GDP growth. Yes,
I know. He's very optimistic. Above 5, above even 6. We could even see 7, I think he said. I was like,
let's
wow.
go. Wow. But you've got inflation holding at around 2.8, even though if you look at trueflation, it's down as its lowest in a very long time. I think 1.18 right now.
Sure.
And of course, the other issue in terms of the dual mandate is the labor market. This is flashing, I would say, lukewarm yellow, maybe. Mm-hmm. It was in a red position. It seems to be pending off a little bit, but I don't know if that's partially due to some of the immigration policy and there's more jobs being opened up for Americans. I'm not sure yet, because I am hearing from CEOs around the country that they're actually looking at a potential hire now, which is completely different where they were in the last 3 quarters.
Absolutely.
No hire.
That's right.
So that in itself seems to be settling in. Then, of course, you look at this right here, which is Tether jumping into 15% of its portfolio into gold. And then the S&P, right as we're talking right now this morning, hit 7,000. So at what point, I mean, with this kind of market, how would you justify a cut, if any? Where would you even look at cutting this year?
I think that the people that want a cut, Paul, the people that are really speaking on cuts are the people that are really more championing the retail consumer and the retail buyer of houses. They're looking at mortgage rates as just unaffordable. The Trump administration tries to tackle that, mentioned a 50-year mortgage, which went over like a lead balloon. Nobody was entertaining the idea of a 50-year mortgage. But you're looking at people that really want to cut rates. They're really looking at the credit card interest rates, and they're saying that this is just not working for the bottom half of the country that rely on this kind of revolving credit to pay bills every month. It's certainly not working to induce the engine of housing and housing turnover in our country. That is one of our biggest drivers of activity, GDP wise. And that's stagnant when you have higher rates. Now, we have to put this in perspective. Higher rates, which we just had the 30-year drop below the 6% level in the last, little bit. That is a normal rate. But when you look at the fact that we've had rates next to zero, a 25 basis Fed funds rate for almost, over 13 years, that basically gave you, I mean, I know myself personally, I have a jumbo mortgage at a 2.65 rate. I mean, that is just unheard of. And it makes me not to ever want to sell that property, right? Because where am I ever going to get another jumbo loan at 2 point? It's never going to happen.
No.
So you stagnate the housing industry. You really deliver pain to people that are paying every month 18% credit card rates. You hear Trump introduce his 10%, moratorium, nothing bigger than 10% for a year. We're getting a lot of these things. The one big beautiful bill is another example, has a $6,000, senior credit against for taxes for Social Security, but it's only for 4 years, 25, 26, 27, 28. So all of these things we can do to short-term relieve the pain. It's kind of like triage care versus really like, what are we going to do to fix the underlying fundamental problems? And the underlying fundamental problem is what I am most caring about. That's why I've been a gold bug since 2020. I said, there's no way we can literally shut down the world and still print stimulus and still keep the economy going and not have massive currency-induced inflation. It is going to happen. Yeah. And so I care more about the fundamentals, but I think that the people that run the government, the Trump administration, the people that are talking about rate cuts that are really dovish, they're really caring about how the individual end consumer is affected. And I guess my perspective, Paul, is that if we're going to fix the problem that we have created, which is we are just addicted to crack stimulus, like that's crack cocaine, like we have to have more stimulus. Yep. If we can't have an economy that's sustained on its own merits of its own actual organic innate inertia of growth, if we have to constantly have central bank fakery, then we have a problem. And I care much more about that problem because I see it coming to a head a lot faster. People think that the dollar not becoming the global reserve currency is 20 years off, and they'll talk about, oh, it'll never happen. It is happening so fast before our eyes. We are in jeopardy of that status because, for one thing, the dollar is no longer needed as a medium of a transactional payment. The blockchain and cryptocurrency just literally will end the necessity of the dollar as a global central holding payment. And so all of those things are converging now. And that's why, to me, the fundamentals are more important than what are the credit card rates, even though it's painful. And I hate to say it, but that is where we are at.
So many people are calling it the June pivot in terms of the forecast. And a lot of, I think the market to a certain extent is pricing in. I think the chance right now is 45% chance of a cut. That would be after the new Fed chair is appointed. Sure. When you think about the new Fed chair, Polymarket, of course, we've seen the potentials here of what this is going to look like, whether it's Rick Reeder, we get Kevin Warsh, or others out there. I know your favorite is Besant. I don't think he could do both jobs, but he's actually coming up the ranks now. I saw him on Kalshi. He was like at 6%.
That's good. I was from 4 or 6. I'm going to take it. No, I love him. My vote would be not for any of the ones. I mean, Trump wants an accommodative, dovish, obviously he wants that. My vote would be for like a Waller, someone who's more hawkish, who's more about the fundamentals, who's more about, where are we headed in the longer short term, meaning the next 60 months, especially as we just are moving to blockchain, stablecoins. Genius Act really did such wonderful jobs of giving us, letting us know that we're going to have it backed up 1 for 1. And it really actually helps the Treasury by making sure that there's a lot of short-term, buyers out there for actual Treasury. So from that perspective, I definitely am I'm more hawkish. And it's not because I want anyone to feel pain, not to be able to afford a house, not be able to pay their credit card bills, but it's because I don't want the sovereignty of the United States to really be eroded by the fact that we will lose at some point the reserve status. We just cannot inflate, and we cannot export our inflation like we have been doing to the rest of the world since the Bretton Woods Agreement in 1944.
Well, and the reserve status it's kind of a catch-22 because obviously the issue will become U.S. Treasuries. Granted, the U.S. Treasuries now are being backstopped by what appears to be stablecoin distribution. So if if Besant and Trump get their way, stablecoins are essentially going to be proliferated around the world to kind of create a new backstop for, instead of countries, now it's going to be companies, and I guess global citizens that are basically going to be in that position. With that being the case, then you look at the power of the intermediary that is going to occur, because you're going to have more centralization for countries as maybe the U.S. starts to isolate slightly if you think about the Monroe Doctrine and what Trump has been trying to do here, which is going to create an exchange model. And of course, that's something that we talk about here on this show a lot is what XRP and Ripple is going to be in the middle of, because they essentially are kind of that opportunity for being able to kind of transition from one currency to the next. Mm-hmm. And if you think about the correlation right now, because of the liquidity cycles, if the Fed stays hawkish this week right now, the likelihood is we're going to see more flight to quality. So I'm just wondering, at some point, we're going to see a broader sell-off, I think, even in altcoins from where we are right now, which is crypto. When do you think we'll see risk assets return?
I do think we have, I mean, Trump really started the year off with the whole Maduro Venezuela situation. So geopolitics obviously are at the forefront. Obviously right now we have potentially interventionist action. We did, the New York Fed did a rate check on Friday to see what their price entry point would be into the market. So that obviously sent some sort of, not shockwaves, but that sent some consternation of, wow, is the U.S. intervening? Is U.S. and Japan coordinating intervention? Right. We do know Bessent met with Japanese finance minister Kato at the IMF and in October at the G7 and G20 in DC, and basically said, listen, we really expect Japan to get off of Russian energy. And obviously they talk about Russian energy, but what the real concern is they have 9% of their liquefied natural gas coming from Russia. And that is something that they are heavily reliant upon. So you have the United States sort of saying to Japan, we need you to do these things. You're supposed to be our ally. You're supposed to not be on this side. But then Japan has to obviously look out for its own energy security and its own energy policies. And then so we could have a yen dollar issue. We could have any kind of geopolitical escalation. We could have anything that doesn't continue to look like we're moving towards some kind of agreement between Ukraine and Russia, especially if NATO starts to believe that this is maybe their pushback against Trump and what he's trying to do with Greenland. You have all of these things happening simultaneously. And trust me, when you are a country or a NATO or a European Union, you're looking and saying, what cards do we have and the totality of everything that's happening and what can we play? And that's why I mentioned all of these things in concert, because they are not all in silos. They are all being looked at simultaneously, which lets me know that I would fully expect more geopolitical activity in 2026 as opposed to just 2025, for example. And that means more uncertainty. And with more uncertainty is more flight to safety. This is a part of the reasons you've seen metals run up. So people will return to risk, but it is going to take potentially the sitting of a new chair, the independence conversation dying down, let's have the market kind of calm down after they freaked out last year in April about tariffs. They then retrenched and said, oh, okay, let's see what it is. It's not so bad. And obviously we had a massive recovery of the losses and a great year. So I think people are going to need to see things kind of get put into place and calmness return. And I do think there'll be a risk play this year. But right now people are feeling uneasy and there's just a lot of things, a lot of balls in the air.
There's been a couple of analysts now calling for a $6,000 gold. Do you think that's in the cards?
Absolutely. I think that, yeah, absolutely. Because when you look at, if you actually try to reverse engineer what gold should be priced at, based on how much we set it as a reserve at Fort Knox when we originally went to the dollar gold, policy. And we just haven't, unfortunately, Paul, we just haven't kept up with transparency. How much gold do we actually have? Where's the last audit? Where's the public transparency? We don't have that transparency. And as that transparency comes into clear view, you're going to see that we've really, I don't want to use the word hyperinflated, but we have massively inflated our currency, and we have intentionally kept gold and silver at low prices to obfuscate that fact. And so one of the things that I think is going to be a big event, but it's going to be not positive, but it's going to be very revelational, is how much have we actually inflated the currency? If we were really trading the amount of gold for reserves and the amount of currency we've printed, I mean, I think we would be somewhere in the 20,000 per ounce range. So $6,000 an ounce is and if you're looking at the true reserve value of what gold should be priced at, it's totally, absolutely reasonable. It's just that it's unusual for it to have gone up so fast. And you have to tie in crypto to that. You have to say, what is the crypto influence on the flight to safety to gold, but it going so hyperbolic so quickly? Parabolic. This is parabolic movement. It's insane.
Well, I think the point is now well, first of all, the growth of tokenized gold. We already know if you look at XRPL, there's several projects out there where we're going to see more tokenization of gold, especially as we see vaulting providers start to get into this, where they'll hold physical, LBMA
yes,
grade
absolutely.
bars and tokenizing. I'm still surprised we haven't seen a solid product come out for tokenized silver, even though we've talked to a couple of people who are on the show who are doing it, but they're very small. They're using industrial grade silver, et cetera, versus, much what we've seen with whether it's Paxos Gold, Tether, obviously with XAUT. But the key here is that tokenization, I think the answer to your question or your statement there was tokenization has entered into a zone where people holding Bitcoin or maybe ETH, some XRP, might be looking at moving into gold. And the way they're going to do it is not physical. They're going with the digital gold model, which of course gets more entry into the gold market because they can do it at fractional. So rather than going out to, our friend Andy Schechtman or someone like that and buying a gold ounce, which is on back order, getting physical delivery. So I think this is going to be another boom in terms of opportunity. Some of the, chains out there, obviously, they're going to do very well with this. I think XRP will continue to get in there. Obviously, the instant liquidity of this in the market for physical is huge. But I think the micro fractions are the reason
100%
that we're seeing retail come into gold.
It's democratized. It's democratized with that. And that is, you can't maybe buy an ounce yourself. You can't even, but you can, even in the ETFs, you can buy a smaller amount, right? You can fractionalize it and buy a smaller amount. So you're right. It has been democratized with its tokenization, digitization, and that makes it open to the masses. And when the masses start to get concerned about what's going on with the market, what about the Fed? They're going to cut rates. My money market's not going to pay me this much anymore. I've got to find an alternative. I'm getting concerned about the global world, what's happening. The Fed's chair is out. There's no independence. We've got, situations and ICE problems, and people are just afraid. And they move to our safety or what they perceive to be safety. And I do think that gold and silver are ultimately the ultimate hard, safe asset classes that are, just publicly known and available.
Well, and the point being is, obviously we've got a lot of pressure right now coming in on where the market sets, which is kind of, I think, the issue that we're dealing with the Fed. And if we get, the back half of this year possibly returning to risk, stabilizing right now and where Bitcoin's price is, which is around 90, it's holding it around 90K, likelihood on a Fed pause, hopefully no more. WEF is over, so at least, because WEF in itself, I think, creates an onslaught of things happening. Immediately after WEF, you have the EU and India announcing big deals.
Exactly, yeah.
You've got, the issue with the Japanese carry trade that possibly could be being unwound here.
Yep.
My question is this. There seems to be stealth QE occurring right now. When would stealth QE turn into real QE? Do you think that's in 26, or do you think that's going to be further into 27?
I think that they will move, especially with the new Fed chair, that if he is at all aligned with Trump's philosophy or Trump's wishes, if he's dovish, right? I think that any kind of instigating event, and I am leaning in my gut to a geopolitical event of some kind. I mean, we could even, China has been threatening to actually execute military action against Taiwan for the last 3 years. I mean, moving ships, everything, very aggressive military action. So anything that is a spark, I believe, this is the scary part of this market. Yes, we had a great recovery. Yes, we had a great 2025. But when you saw, for example, I believe in October, we had a 2% pullback and the fear and greed index went to extreme fear on a 2% pullback. So what that tells me is that investors are just very unsure. They are unsure of, okay, this AI thing, this blockchain thing, this quantum thing, we think that, yeah, this makes sense. There could be real valuations here that are really going up organically. But wait, something bad happened and the Bitcoin sell off and liquidations and margin calls. Oh my gosh, I'm totally afraid. So there's not a lot of just deep rooted confidence in the equity surge that we're seeing. It's an unknown. AI is unknown to people. Bitcoin and crypto is unknown to people. These aren't things that they can say, yes, people need RJ Reynolds because we have to have aluminum foil, and people need, Procter & Gamble because we have to have toothpaste and shampoo. They cannot wrap their heads or their hands. There's nothing tangible about these concepts. Everything is in the intangible world. And so it is very easy for these investors to get spooked and really run for the exits. And so I think any impetus, you will see them propose potentially massive stimulus, depending on what is happening, because this market could react very negatively very quickly. I mean, that is the problem. The volatility goes both ways. Upside is beautiful, but a little bit scary. And obviously the retrenchment and the downside and the gapping down can be very aggressive and scary as well. And people are just not 100% comfortable with where this market is and where it's headed because they don't understand it. It's like asking second graders to invest in a college calculus, and it's a foreign language. And a lot of people will never do what you do, what I do, which just take the time, understand what's going on, understand how it's being leveraged, how it's being used for all kinds of new functionality that you just couldn't even think of in your brain. We're excited about it, but a lot of people are very leery of these kinds of things.
Well, and to your point here, I'll bring up a tweet. Let me bring this tweet up right here. This was Vitalik talking about it. Obviously, Vitalik Buterin. Greatest fear is if crypto just becomes a speculation, no real applications. Back to your point right there is that you need real world use case. He warns if people only gamble, this industry is going to die. Which has been the case over the last 2 cycles. It's been a casino. And now to avoid that, obviously we got to build real value. And he's talking about, DAOs, dApps, et cetera, real use. There's only a handful of companies out there that are creating utility. I think ETH in general, because of it, it's more decentralized approach. But when you can go pin a dart on a board, there's only a handful that kind of fit that model. One, of course, is Ripple. They make a big difference. Of course, their new G Treasury acquisition last year, now their announcement of the Ripple Treasury, which essentially is going to attack the Nostro Vostro situation, put a lot more cash to work. That's the kind of utility that we're talking about. Obviously, that has a follow-on effect on XRP, the token. But I think Vitalik is right. And to your kind of following along what you're hitting at, this is where we are. I think we're going to see the crypto market shrink into maybe 20 to 30 major projects where the big people will invest. And I'm talking about institutional capital.
Sure.
We had Avalanche launch an ETF, went 0 net inflows. So that's the kind of thing that I'm concerned about when you get that kind of issue occurring with a token that is a top 20, so
that's
a little concerning.
Alarming.
And obviously DeFi, more open DeFi, which is going to be, I think, the magic bullet for everything going forward, especially when you look at the demographic shift that we're dealing with. Most people under the age of 40, they understand decentralized finance. In many cases, that's how they're banking today.
Yeah, I love it. I love it. I wish we had more of it. The banks don't want it. The banks are doing everything they can to lobby and control everything, as you know what they are doing with the Clarity Act. I mean, I do think that obviously the baby boomers we are 2030, the last boomer reaches what we call FRA, full retirement age. And so that population is really aging not out, but aging less into productivity of what they're consuming, and the wealth transfer obviously going down to Gen X and then to millennials and Gen Z and then Alpha. I mean, we're seeing it. But the fact is, you are so right. Until people actually can see beyond just ChatGPT and Gemini how they're actually leveraging AI in their life so that they have something tangible that they can they can tether to. They can say, yes, I understand what this is and why it's necessary. I see the benefit. I see the value in my own personal life. Now I'm more comfortable with it as an investor, or I'm more comfortable with the shifting of payment systems, the shifting of like all of these things have to be accepted by the public and really, taken on. And they are. It's happening, but it is still a lot of concern for a lot of investors.
What happens on yields? Because obviously the Fed's going to hold steady. If they hold steady for the next three rate meetings, and if inflation remains sticky, then real yields potentially could rise. How damaging is that for something like its non-bearing asset like gold and silver? Do you think that slows this train down if we get more yields in other asset areas?
I mean, we have seen a rotation out of gold and silver ETFs back into money market when yields rose. Like people will say, "Hey, I'm getting a gold. Gold is just going to sit." You have all those people out there. They're like, "Gold hasn't done this for 20 years, and for 50 years, gold was like a bad, and all of that." But they're missing the point. The point is we are at a precipice of a new, new thing, completely new thing, and so they're kind of missing the point when they talk about what gold has done since 1944 to date. So we do know that as yields rise or fall, we do have a rotation in and out of metals, and we do see that, and we also see that with the blockchain. We also see that with Bitcoin for sure. So it just depends. I just think that yields are not going to get back up to as high as they were when people had that much and felt comfortable keeping that much in money market accounts and money market equivalents. And so I just think that gold is not rising because of anything other than all of the transition that we're going through, all of the centralization to decentralization, all of the hyperinflation that's going to start to be revealed through the transparency of the blockchain and the ability to, when you mentioned to me a few minutes ago, you said, there's some stealth quantitative easing happening. That's exactly the point. Why is that happening? Why do we allow that to happen? Why don't we know exactly what the Federal Open Market Committee actions are way before they're actually publicized? Because, the minutes and everything come out so late. The actions are produced so late. I mean, everything has to actually be disclosed, but whether or not it's disclosed in a way that it gets picked up, it gets talked about. I remember they changed the calculation for CPI, and they went from a 2-year price change categorization to a 1-year price change categorization. And I was the only one talking about they're changing how they're even computing this as they're doing it. No one's talking about it. These are the kinds of things that are happening. It's like stealth this, stealth that. And at some point, people are going to just demand transparency. We have the blockchain. Let's get everything on the chain. Let's understand what's happening. That's when you get the reevaluation of assets because of the hyperinflation that has occurred that they've been able to keep down and keep metals tapped down for the decades they've been able to do that.
Yeah. I think one of the things that could make gold go parabolic even more so now is if we were to see the launch of a dedicated asset base for gold, specifically outside of a XAUT and Paxos, something where you could earn yield. And there's a handful of companies that are kind of toying with this idea. I know Flare Networks, of course, they're talking Bitcoin, XRP, and Doge right now as what they call an F asset, where they basically, because most of these are obviously non-smart contracts, so they basically add the layer in there that enables you to trade it and, of course, earn yield against it, take it into DeFi.
Interesting.
If you could take gold into DeFi, ooh.
But do you know what, Paul? That's exactly what the banks are attacking. They don't want the ability to have yield on stablecoins. I mean, and that is such a, oh my gosh, it's such a, like, let me put my old framework on top of what you're trying to do that's new so that you will not want to leave my banking world. It's so sad that you have to lobby to get those kinds of things controlling because you can't compete on it in the open market. It's just pathetic.
Well, and there's a handful, I think this is coming, obviously DeFi is continuing to expand. We're going to see the tokenization. We've already seen the element of what RWA has done for tokenized stocks. It's just a matter of time before we see all of this, including gold and silver. So it's just a matter of which companies are going to be out there doing it. Hugo, if you're listening to that, he's the CEO of Flare Networks, and we've had him on the show before. I'm like, maybe this is something Flare needs to be looking at, because of course that changes the dynamic of where a lot of these spot markets could be going. I think they just listed also over on Hyperliquid which is just another way for, and now you've got gold futures, silver futures now on platforms like that.
Beautiful.
So again, that's going to open it up to a next generation investor.
I love it.
And boom, you've got huge opportunity
Absolutely.
going forward. All right, so let's get going here. Last thing I want to hit on here in terms of the Fed. Obviously, you're saying push out to end of this year for risk, depending on where, as long as we don't get anything crazy on the volatility side or the uncertainty Trump card that might get played. And then, of course, you're still very bullish on gold in terms of an upside for gold.
I am, because what people just don't seem to get and just can't seem to, they might get it for a minute and then they leave it again because they're just so used to gold being just kind of a monotone asset class, right? As like I said, gold has done over the last 50 years. So I do think that this is not that. This is the beginning of central banks having to have their come to the light moment and disclose in some way, shape, or form. And I'm not saying that it's something that they want to do, but there is going to be more transparency. You've heard about us auditing Fort Knox. You've heard about this. So as we have a move towards bi-directional, we talked about this on the last interview that we did, bi-directional trade in domestic currencies between India and China, between India and Russia, between China and Russia. All of these things used to involve the US dollar. I mean, I think that when Russia invaded Ukraine and the West reacted by kicking Russia out of the SWIFT system, that was really, and this is post-pandemic, that was really the very beginning prick of the balloon, a slow leak of a balloon that says, you know what? We aren't going to do this game anymore. We aren't going to be beholden to the West. We're not going to be on their economic sanctions. We're going to directly trade in our own currencies, bypassing the US dollar. We're going to get, even though it's officially not like completely announced, OPEC not, I think you'll see sales of OPEC outside of US dollars. I mean, these things are coming. And as that happens and the dollar becomes less and less relevant, what is the relevancy? If the dollar is not what it was, what do people turn to? They looked at the dollar, and this is what we forgot. People looked at the dollar as a barometer to gold because it was tradable for gold. Obviously, we went off the dollar standard completely. We went off the dollar standard partially in the United States in 1940, I want to say 41. Or something, when FDR basically executed the executive order and said you have to turn all your gold in. The Americans could no longer exchange dollars for gold, but the rest of the world could. Richard Nixon finally killed the gold standard reserve by saying, okay, in 1971, we're no longer going to take the currency back and give you gold. We're not going to do that anymore. So we have been off that gold standard since 1971, and the hyperinflation of currencies began. Look at the actual oil embargoes, the inflationary period that we had. We just had ended the tethering to gold. So what happened was we just said, okay, people are so used to us being equivalent of some portion of gold that they'll now accept the US dollar, and they accepted the US dollar as the standard. That is now going to change. And as that changes, we have to look to something else that is a true hard asset tether to reality. And that's the problem. There's so many financial derivatives. We're way beyond too big to fail. We're way beyond where we were in 2009 on the financial derivative machine of the world. And so when you realize how much we've derived value from assets that are down here still, you've hyperinflated the tethered assets. And that's what is happening. And it's a slow burn, but it has begun. And that is really, I believe we could probably look back economically years from now and say when Russia went off and we kicked them out, and then the rest of the world had to figure out there's so much trade going through the Black Sea right now and has nothing to do with the US dollar.
Yeah, exactly. Well, and the point you're getting at, the more you talk about this, Rebecca, it makes me think, especially if you think about this hawkish hold signal that's going to be coming out of the Fed, you're going to see more flight to safety. I think we're going to continue to see that. I'm curious if we don't see, and I keep mentioning Flare because they're the one project out there that, they run this thing called time series Oracle, which is basically it expanded into real world assets for price feeds. So if there were a gold USD price feed, then you could see maybe that becoming a permanent fixture. What that simply means is you'd be able to get gold backed lending and borrowing on these DeFi networks. If that were to get into, and the
Wow.
only reason that could happen is because of what we deal with on a Fed that's holding a little bit longer. Risk assets continue to grow.
Mhm.
RWAs are going to become, I think, proliferating throughout the land. This is very positive for what Ripple and Flare
Yeah.
together could end up doing. So,
Yeah.
which it could tie into gold much more efficiently, which is kind of what we've been talking about today. I'll take a quick look at the gold price as we are stopping here, but it's getting ready to hit 5,300.
This is so parabolic. That upsets me because I like it to establish some support at each tranche, and we're not doing that. We're just jumping, and there's no support.
There you go.
So,
That's the chart right there.
yeah.
$5,300 right now as we're trading, almost 52.83. But remember, this came off of,
I know.
what was it? 51.87 close yesterday.
I know.
Started the day at 5,000.
Yeah, we just hit 5,000 this week. That's right.
Crazy.
It's insane.
And just remember, I mean, we've done several podcasts, several videos all the way back to last year at this time, basically kind of getting people ready for what could be an exodus into metals, and it happened.
Yep.
And of course, we've seen it. That's the chart there for gold. Let's go all the way back here just to give you guys an idea of the kind of chart we're talking about here. This was September of just last year, third quarter. And I can't even get to the top here. Let me squeeze this down.
Wow.
Right there. That's a 40% move. I mean, most people would say that's an altcoin.
Exactly.
Okay.
What's this volatility? What's happening?
Yeah,
oh my
that's an altcoin, but it's trading right now, obviously where it is. Very, very high volume sentiment right now. I notice it's God almighty, this is all green indicators. I don't know if you can see that right there. I'll zoom in on this.
I do see it.
But that is all green indicators right now.
Yes.
On our sentiment indicator. Trade MSI way up, volume sentiment way up, net volume up, overall average way up. So signals are very hot for this right now, which is a little scary.
I mean, I think it's scary because it's definitely signaling that there is an absolute under the radar, under the current sea change actually happening before our eyes. And I just don't think that people, when you ask them, why is gold going up so much, you have a hard, even Jamie Dimon would probably have a hard time explaining exactly why it's gone parabolic.
I mean, come on, let's just say it though. JP Morgan kind of got caught, a little bit flat footed here. This was in December, and they said, and now here we are breaking straight through. So
yeah, well, they started off wrong. Gold prices soared in 2025, driven by tariff uncertainty. No, sorry, that wasn't it. That wasn't it.
Well, so there you go. That's the point I'm getting at. So,
yep.
Which is interesting because we are going to continue to see a lot of. Did you see him Dimon respond to becoming a treasurer, basically the Secretary of Treasury? So, I mean, the idea was floated that he would at some point and of course Trump kind of discounted the whole thing. So, but it was Dimon acting Dimonish.
Wasn't it something? His sentiment was something like,
he was going to be the Fed chair.
Yeah, wasn't it something? The sentiment was something like that. I thought I heard sentiment like the job wasn't big enough, or he couldn't deal with Trump, or something like that. I was like, what? Hey,
listen, the old guard, I think, is in for some trouble here, Rebecca. So
100%. And that's the problem, because we're the old guard. America is the old guard. That's the thing. I mean, if you just think of it in terms of what do we actually collect in tax revenue and what do we spend? Like, if you're looking at a $7 trillion, exactly, you're looking at a $7 trillion annual budget. We're collecting 4 plus 4.5. 5, not really, but let's say we're collecting 4 trillion in the total, 4 to 5, and we still have a $2 trillion a year gap that we're selling our currency to fund. So that's 2/7. It used to be a little bit more. It used to be more closer to half. But the point I'm trying to make is, if we don't have what we currently have, which is the dollar reserve that's needed by the rest of the world to transact business, to buy petro, if we don't have that, we could lose $2 trillion of our ability to create, funds overnight. What do we do with that?
I don't. Well, I think that the unwind of treasuries it has already started. We've seen, China dropping a large amount of U.S. treasuries. Didn't have much of an impact on the bond market. But you also have, I think, at the time right now, which is this dynamic shift to stablecoins. But the catch-22 is that you almost have to dismantle the bank industry.
You do, I know.
To get the stablecoins proliferated throughout the world so that basically the U.S. can rebank itself on global citizens.
Yes.
And it's going to be at the cost of the banks, I think, in the eventual side of it, unless banks obviously gear up and compete and start to understand, hey, we're going to use stablecoins, put these to work in DeFi and those kind of, institutional markets and play with the big guys, in terms of how crypto has been doing it. So a lot of stuff happening. Rebecca, it's always great to have you on the show.
I would just say, Paul, so far the banks have obviously just done their standard operating procedure, which is
nothing.
Lobby Congress to make sure that we don't become irrelevant through laws. And unfortunately, you know this is true. Congress, the United States Congress, is not going to be able to stop the world moving to blockchain cryptocurrency. It's not possible. So we're actually, the banks, what they need to realize is they're actually asking the United States to accept being second class and not be we need to be the driver. We need to be the actual designer. We need to be the one that is driving this transition, not stifling it and letting it go over to somewhere else and becoming the hub there. So that's the problem. We became what we became because of Bretton Woods, because everyone said, yes, the U.S., yes, the U.S. If we try to say it's still us and we're going to contain this to be the old way, it's going to get done somewhere else, but it will get done.
Yeah, for sure. Rebecca Walser, you guys can find her over at Walser Wealth Management, one of the best out there if you're looking at getting your assets to work. She's one of the top people to go see. Thanks for coming in on the show today. We appreciate it.
Thank you for having me. Glad to be here.
You bet. All right, you guys know what to do. Make sure and like and subscribe. Also, if you have an idea for a guest, drop it in the DMs, or you can actually drop it here on one of the comments on the show as well. And we'll catch you next time right here on the XRP Pod. Take care.